Good morning and welcome to the Market Carver. I hope you've had an outstanding week. Obviously, with the government shutdown and the things that are going on in Congress, there's many things that we could talk about the allocation. I decided to use this to really do a year-end checklist for things that you need to work about or think about or possibly consider. We're going to cover them at the Thirdlies as well. But for some of you or those of you who can't come, I want you to be able to get this checklist, understand some of the things that we can do for you in the back room with the paraplanning team or the planning team, but they're things that are important. I like to remind folks that nothing will separate you from your retirement like the IRS. It's when you pay that money to the IRS, that money is gone. They never send us a check back. When the market goes up and down, at least if the market recoups, we get that money back. We've got to pay attention to the tax code. So first is on required minimum distributions. Make certain that you have those done. If you're part of the FEG family, your IRAs, we're already on top of that. All of your distributions can come out of one IRA. On the other hand, if you've got a 401k or multiple 401ks, remember if you're forced to take a required minimum distribution, it has to come from each one of those vehicles. Please don't forget, as it's a 50% federal penalty. Number two is the 529. Indiana allows for the College Choice Plan. You can put up to $5,000 a year into the 529 and get a $1,000 tax credit. That's a dollar for dollar reduction on your state taxes. That is a beautiful deal, something everyone needs to take advantage of if they have any future educational costs at all that could be out there for themselves, children, or even grandchildren. A wonderful opportunity and a 20% return on a tax credit from right from the get-go. Number three is on the Roth. Make sure that if you're eligible to do a Roth contribution, in other words, you had earned income and you didn't make more, married filing jointly more than $160,000, that we move money from one account into another. Get that Roth funded. Tax-free money is critical. And also, if you did a Roth conversion or haven't done one yet, we may want to look at where we are in the marketplace right now and consider doing a Roth conversion, moving IRA money to Roth money. The next point is right along with that. Let's pay attention to our taxes. About every year, somebody comes in that did their own taxes or the end of the year, and we'll have a sizable account for them or a sizable IRA, and they essentially wind up in a 0% or maybe a 3 or 4% tax bracket effectively. Folks, if your income is going to be below $50,000 this year, your taxable income, it is important that we pay attention to getting money out of IRAs, getting them into Roths, recognize income taxes at these lower rates before things change. It's a beautiful opportunity to be able to do that. Also remember, if you stay in the 15% marginal capital gains rate, that means if you're married filing jointly and your taxable income is below $72,000, your capital gains rate right now is 0. Many people live off of dividend income. That dividend income is taxable to you, whether you're at a 5%, 15% bracket. If we can convert that to capital gains types taxation to give you the same amount of income, literally you're going to pay no taxes on those capital gains. It's important to work that tax return into the tax planning, and that's really the key with tax planning. This is not something that we're able to do next year. This is something that's got to be done in the calendar year. And then when you go see your CPA, when I go see my CPA and we do the tax reporting, that's next March, due in April. And there's nothing we can do to go backwards to make up some of this stuff. So we've got to get it done now. Remember, anybody that is under 70 and a half that has earned income is now eligible to be able to do a non-deductible IRA that you can convert to a Roth in some cases. Don't do that on your own. There are some things that are technical about it, but there may be an opportunity for you to be able to create some tax-free income regardless of where your income happens to be. And don't forget the gifting. If you do have required minimum distributions, you can go ahead and make a gift of that RMD directly to a charity. Keep that money off of your tax return. I had a person here this last week that said, Joe, what difference does it make if I give it out of the RMD or if I give it somewhere else? Well, here's the deal. Your tax return, each and every single one of those lines comes together to create an orchestra, if you will. They work together to make certain that they're in harmony, but it's like having a bad instrument in the symphony or the orchestra. You can hear that one the bad sound that comes in. It disturbs everything else. Each line on a tax return functions independently, but they all work collectively. So if we can keep capital gains, or if we can keep our income, dividend income or interest income off of our tax return, our Social Security is taxed less, our Medicare Part B expenses are lower, lots of reasons to really pay attention to this. But we need to do it this year. you can't do it next year to prepare for this year's tax return. So I hope those 7 steps gave you some good insight, good ideas. We're more than happy to help you with them at the Financial Enhancement Group. If you are already a family that we're taking care of, you know that many of these things are already in motion. That if you've got other money that's out there in a 401k plan, or you've got other accounts that are somewhere, and we don't know what your adjusted gross income is or your tax deductions unless you've told us those for the year. If we have those, we can help you do some serious tax planning, make things better so that when you do report to the IRS next April, you'll have a happier smile and a better financial journey. There is nothing that will separate you from your retirement like the IRS, and anything we can do to prevent that from happening, we are more than happy to help. If you're out and about on Saturday morning, don't forget to catch the radio show, 9 to 10 on WQME, 10 to 11 Sunday morning on Chai 99. This week, we're actually going through and doing a financial planning case, taking a family through accumulation, preservation, and eventually into a distribution phase for retirement. I try to do this for my Purdue class every now and then, and that's what we did on this week's show that will air over this weekend. So if you'd like to hear that, please enjoy it. Saturday morning, don't forget the Herald Bulletin. The article coming out this week will be in the Saturday paper. And if there's anything we can do to be of service, please don't hesitate to let us know. I hope I get to see a lot of you this week at the Thirdly, and look forward to spending some time with you. God bless. Have a great week. Look forward to seeing you again soon.